It's been quite a couple of years for hedge funds and many strategies weren't doing so well. But this time around, long short is really benefiting. What's been the driver of that?
Yeah, Bonnie, first of all, thank you for having me. And it really is, this is such a great question for today because it's head spinning which way the markets are going to go here. You know, day to day, there's volatility. We've got the election. We have a vaccine upcoming. There's a lot of volatilities in this market, and calling the direction is really hard. But what's important for long short equity strategies, most importantly, is dispersion to see winners and losers. And post the financial crisis, like you said, long short equity strategies really struggled, predominantly more because of the short book. The long book, we had really good long alpha across the majority of our managers. It was that short book that was really challenged in this rising market. But you know, accelerate to where we are today in the cycle and where we are today in the pandemic. And we've got some real opportunity here for dispersion as money is really flowing differently. I think all of our lives have been changed by the pandemic, and our companies, if we're not traveling, where are they going to spend that budget? Personally, if we're not traveling or doing things, where are we going to spend our money? And that's going to create these real winners and losers that we haven't seen for a long time.
I think we actually have a graphic of the hedge funds that have been performing best so far this year. And, you know, of the top 10 or so, many of them were long short equity or at least macro type funds. What were the arguments, though, Lilly, that led you to invest the way you're investing in whatever longs you're in and short wise as well? Because if the pandemic hadn't arisen, and I mean, let's face it, no one was anticipating that kind of black swan event, would those arguments have held up?
Yeah, interestingly, we really thought that this trend of dispersion coming back to the markets where kind of the decline in interest rates, you cannot refinance your way to growth anymore. That was what we had kind of post the global financial crisis. And in this environment, it's different. You can't refinance your way to growth. So there's going to be dispersion between high growth companies, low growth companies, companies that are winners and losers here. And so as we came into the pandemic, we were actually quite constructive, even at the end of last year, coming into this cycle, that we had dispersion at our back for long short equity. Also, volatility was coming back. You know, we don't want too much volatility, but certainly volatility is our favor. If we have high hit rates at our long short equity hedge funds, if you have volatility, it gives you more chances to kind of realize that high hit rate and also have a kind of bigger slugging percentage.
Do you have high conviction areas now for your longs and for your shorts? Can you give us any clue as to the areas and perhaps even some of the stocks?
Yeah, I'll focus on kind of the strategy perspective because that's really kind of our focus here at K2. And I think what's really interesting today, and it's been a play that we've had a high conviction in generalist long short equity managers, which is quite contrarian. It's going back to the foundation of long short equity with managers who are going to be able to capitalize on this dispersion as money is really flowing differently through sectors. We still adore our technology and healthcare sector specialists. But we think this pandemic is going to play out really differently in different parts of the market. And so a generalist will be able to adjust whether their regional exposures may be different. They may adjust which sectors they're tilting towards and against, and even within the subsector level. So interestingly, we're most constructive today on generalist long short equity within the long short equity space in particular.
Now, have you been swapping up managers at all? And has that been dependent on their performance or on something else, Lilly?
Yeah, every crisis, unfortunately, gives you a few winners and a few losers. And we have a really long-term time horizon. So I wouldn't say that we've turned over more managers than we have in the past. But it's after a cycle like this that we look forward at all times and say, where should we be allocating? Where are the biggest opportunities that we think we can find? So there has been some turnover. But interestingly, I think also just it's worth commentary on the launch environment in long short equity is really great. They're not going to be a high volume. They're not going to be a lot of launches in this environment. However, the pedigree is going up. Kind of the terms and conditions that we're able to negotiate for our clients is improved, and the pedigree of the managers that are launching today are improved. So that's a great environment for us to be making new allocations.
Longer term, do you still see the appetite for hedge funds that we saw in the past, Lilly, or has the amount of money flowing into other types of, you know, vehicles, even Spacs, for example, has that taken away from the hedge fund manager attraction?
Yeah. So at any given time, I think the hedge fund industry, we had a rising kind of a increasing pie, right? And the pie is pretty full now, right? We've had all the new allocators have come to the strategy over the last, call it 10 to 20 years. And so our growth is going to be at the rate of either GDP or the market growth, but where the money moves within that pie, what strategies people are going to be allocating to may be different with where we are in the cycle. And also where we think our pie as hedge funds in general right now could grow is if you think about an asset allocation plan here, do you really want to be very long equities? I know we are in a great rally here, but there's increased risk in that rally continuing. And also, therefore, on your bond side, is your bond portfolio going to be able to generate the returns that it has over the last few years? Maybe you're looking for some defensive equity. Maybe you're looking for some uncorrelated strategies that are more defensive for your overall portfolio. So we still think that the hedge fund space will grow, but it's more going to be moving money around within the strategies within the hedge fund space.
Curious as to what you think of the, re-emergence of the Spac this year in particular. It's just attracted so much money.
Yeah, and you know what? It's interesting for many people. We really were challenged by the Spac environment of several years ago, and left that strategy almost for dead. And what we're seeing today is a reemergence of SPACs. It's across a lot of different strategies. We see it coming into our hedge funds. We see it coming up as a single strategy. It's either an opportunistic trade or a part of a strategy, individual strategy. And what's interesting about the SPAC space today, we think there are really good operators who can execute on these SPACs. But just like in every kind of bubble, and I don't want to call it a bubble, but it's more that whenever there's a huge momentum into one strategy, it attracts some players that are lesser quality. So we are cognizant of there are high quality players there. We are cognizant that some will have very good liquidity, some will be more challenged by liquidity. But we think as a strategy within long short equity in particular, it is certainly viable, and some of our event-driven managers also participate.
So I just want to point out a terminal here that we have, Lilly, and it shows that retail's favorite stocks have actually outperformed the favorites of pros in the last several months and years. I mean, there's a lot of ways to read this kind of a chart, right? But what would your reaction be to that? So the blue line, for example, is the hedge funds VIP stocks, and the yellow is the S&P 500. So everybody is outperforming, or at least these two groups are outperforming, but retail is really outperforming.
Yeah, full disclosure, I can't see the chart, but I can talk about just in thinking about the hedge fund VIP. Really, what we have to focus on is that the VIP list, but understand that that VIP list, there's a much broader investment universe out there that our managers can participate in, and some of them are going to be down in capitalization. Some are going to be in the crowded trades, but we are constantly constructing a portfolio that will have a mix of these strategies, right? So that we're not focused on just the hedge fund VIP list.
So Lilly, you obviously have a lot of money to invest, and I'm curious as to whether the recent environment in the United States and the upcoming election is forcing you to consider how you invest, or is having you just consider it organically?
Yeah, we spend lots of time at K2. I can't tell you how much time talking about whether it's the election, whether it's a vaccine, right? What happens to the markets if we get a vaccine? What happens to the markets around the election? What we do spend a lot of time, we do talk about it a lot, but we're making sure that we're listening to what our managers are seeing and the adjustments that they want to make in their portfolios to be prepared for that volatility around those events. But at the end of the day, they're not material changes, right? We're going to have long duration investments and asset allocation plans that go for much longer than just the period around a virus vaccination or around the election. But yes, certainly, most certainly, we want to be cognizant of these things and make sure we understand how we're positioned around them.